So with that, we have gold essentially at new all-time highs. So gold is traditionally a safe haven, an
Yep.
inflation hedge as the dollar falls, which it has over the last year, and which it should with, quote, falling interest rates. Right, so dollar down, gold should be up a bit. But all-time highs?
I think gold is moving higher for a few reasons. Number one, many view it as an inflation hedge. I think history is mixed there, but let's assume for now that it is a good inflation hedge. That is one driver. We certainly know that there's a whole lot of geopolitical risk out there as well, and it's historically a good hedge against geopolitical risk. We saw what's been going on in China over the last couple of days as they're hosting leaders from India and Russia, North Korea. I think the third driver here is demand from foreign central banks. And what I saw data last week that actually showed that the foreign central bank holdings, actually about 30% of foreign central bank holdings are actually in gold. And that's the first time since 1996 there's more in gold among their holdings than treasuries. Treasuries are about 25%. Gold is at 30%. That is a huge reversal. And I think a lot of this is because they just don't want to be as dependent on the dollar or US assets as they used to be. They know that we can weaponize it. They've seen what we've done with Russia and sanctions. And so I think that they're looking to diversify. And that's just another catalyst.
So if I hear what you're saying, if gold is replacing the dollar for these reasons, then it suggests that interest rates ought to continue to move up if foreign central banks, et cetera, aren't buying U.S. debt issuance.
That is the concern. That's why within our portfolios, we're focused on the shorter end of the curve. And I think that a lot of retail investors don't generally buy 20, 30-year debt anyway, but it's certainly, one of the reasons that we're not about to start. And we want to be very careful and position for the possibility that rates could go higher here.
And I want to talk about California munis and real estate in a little bit. But before we get there, the Goldilocks case would be you can cut the front end of the curve. Fed can lower rates. Inflation is tame. So we can lower rates, stimulate growth, and then essentially the philosophy is that rates where they are now at the short end, mortgages and the like, are too high and it's choking off growth. Goldilocks is we can cut them and get things liquid again and moving forward. All right, so let's assume that's true, just for argument's sake. And at the same time, the long end is moving higher, the reasons we discussed. So we've got a steeper curve and more risk in the system, geopolitical, all the other elements. Okay, let's say that happens. Stock market's at all-time highs as well. Are things priced to perfection?
I think that we're in a situation where we are vulnerable to downside surprises and disappointment. I think another way of saying that is that, at least over the short term here, we are priced for perfection. And we're banking on a lot of things going right. One of them being earnings continuing to accelerate and outperform expectations. The other one is inflation returning back to 2% or something that is represents a healthier rate of price growth. So I think that any disappointment to disrupt that narrative would not be a good setup for equities, especially at current valuations.